Hello friends, today we are going to study economy. In this video, we study a basic topic that is related to banking. Let's start. So in this is a banking topic. Banking. In this we talk about the interest rate. What is interest rate? You always heard in the news that RBI is going to increase the interest rate and some repo rate, reverse repo rate, CRR. The, these are some of the basic terminology which we usually use in banking. And interest rate is a rate in each country. If suppose this is a country, in each country there is a bank that is usually that can regulate the banking system. In India, that is RBI. In USA, this is Federal Reserve Bank. Federal Reserve. So the rate at which, and RBI is representation of the government. So the rate at which these reserve banks are providing loans to banks, that is known as interest rate. So today we are going to see a case study. In this we say, suppose Reserve Bank has increased the interest rate. So what are its implications? There are many implications. In this video we study some of the implications. First, so this is our Reserve Bank, Reserve Bank of India. Then these are the banks which borrow money from the Reserve Bank. If RBI increase the interest rate, suppose let's take they increased their interest rate is 6% and banks are giving loans to the customers. So if they are giving loans to the customer, then obviously they are going to provide loans above the 6%. So let's take it as 6 plus 2%. 2% is the profit for the bank. Their operation cost comes under this. So now what will happen? What are its implications? So the total cost is increasing for the banks. So what banks are doing? Banks are shifting their cost to the customers. So whoever is taking loans, that loans are costlier. So we see some of the implication of this kind of increase in interest rate. First implication is whoever is take loans and credits from the bank, they have to pay more interest rate. So these things become costlier. Second, what will happen if the interest rate is high and the things are costlier? Then obviously people will take less loan. What is the implication of this thing? It will slow down the economic activity. Slow down the economic activity. Slow down investment and expansion. And third, it will affecting the companies. Obviously, the company's financial performance is also going to affect. Let's understand the third topic, third point with a case study. Suppose I am a company A and have borrowed money from the bank, suppose 100 rupees I have borrowed and I have started my company and it is a profitable company. And after a year, I am making a profit of suppose 12%. So if I am making profit of 12%, but I have borrowed money from the bank, in this case, the bank is charging 10% interest rate on the borrowed money. So I have to pay 10% to the bank. So I have to pay 10%. Now I am left with 2%. So in 2%, I have to make my strategy in such a way to remain competitive in the market, to see the long vision for my expansion, to see the welfare of the employees. So it will be difficult for me to strategically manage my company in long term, because it is going to influence my expansion plan to have some more plants or to increase my production unit capacity to purchase new machines. So that's why the whenever banks are increasing interest rates, it is influencing the company, and you will see that whenever RBI is increasing interest rates, then in those cases people are not happy, and during those time the prices of shares reduces, because that is not a company or market oriented kind of policy, but RBI is doing to curb the inflation. We'll study inflation in another video. Thank you so much for watching this video. Today's quote is, change your thought, you can change your world. Thank you so much.